Hi and welcome to another edition of Top Tips Tuesday. This week's tip is for those homeowners or investors looking to refinance their loans. So this is not specific financial advice, it's just some of the tips that I look at and some of the things I consider when I'm looking at refinancing my own properties. So number one is considering the difference between the variable rate and the comparison rate. So a lot of clickbait material gets you in by a very, very low variable rate, but quite often these lower rates have a lot of other associated costs related to them. So there might be like an annual service fee, monthly charges, other costs associated with the loan. So there can be a big difference between the variable rate and the actual comparison rate. Just always consider the comparison rate because that's really the true rate with all those costs, and make sure that you understand the difference between the two. Number two is consider lender's mortgage insurance. So if you're borrowing above 80%, generally the lenders will charge you LMI. So that will be a figure that you pay when you first take on the first loan for the property if you're above 80%. If you refinance, you may need to repay that LMI figure. With the property's value increasing in value, it might not apply, but always ask the lender or the broker how much will that be and factor that into your cost savings versus cost purchase or refinancing costs. Number three is loan features. There can be a big difference. So generally the lower rate are very basic and they don't have a lot of facilities. So things like drawdowns, redraw facilities, offset accounts. Even though you might pay a little bit higher for the rate and the actual rate for those facilities, they can really save you a lot of money if you've got more money coming in than you've got going out, and having that surplus money sitting in offset accounts and things like that and being able to transfer without being penalised rates can be a big thing. So just check the features of each loan product. There's a huge amount of loan products even within each lender out there at the moment, so you just got to be very specific and ask the right questions. Number four is calculate the amortization rate. So what that means is when you take out a loan, so it might be a 25 or 30 year loan, the repayments spaced over those 30 years will remain the same, but what does vary is the difference between the amount each month going towards the principal and the amount going towards the interest. So this applies if you're looking at a P&I loan. So generally in the first few years of the loan, the banks put most of that monthly payment towards the interest, very little pays off the principal. But as you go a longer term into the loan, the percentage starts to swing, and about halfway through the loan term, generally, you start to pay more in principal than you do in interest. So if you've had a 10 or 15 year mortgage, you've just got to factor in that if you started going with another 30 years, you might lose that 10 or 15 years where you've been paying mainly the interest and have to start again. So always weigh that into the factor as well. So if you're looking to refinance, what I personally do is take it on the new term of the loan. So if you've got a 30-year loan term and you've got to the 15-year stage and looking to refinance, just base the new loan comparison on a remaining 15-year term. The fifth thing is speaking to a great mortgage broker. As I mentioned at the start of the talk, there is a huge amount of loan products. The banks are continuously changing their products. I personally find it's a very confusing trying to match apples with apples because so many products and they're constantly changing. The great thing for those looking to refinance, it is quite a competitive market at the moment. The banks have opened for business again, which is great. Their number of lendings are down over the last 12 months, so they're actually looking to acquire new customers. That's just great news for us as home buyers and investors. So look around, but having a good mortgage specialist and explain to your mortgage specialist what you're actually looking to achieve. So it may not be the best rate. If you just simply want to pay that loan off, it might absolutely be that way. But if you're looking to redraw the loan down or pay it off early or use the equity to refinance, that will impact the best lender or the best product within that lender for your specific circumstance. So a good mortgage broker that's qualified and had a lot of experience is a huge benefit in your mind. So hope that's really helped. Exciting times for homeowners and investors at the moment. And if you'd like to speak to be introduced to a local finance specialist that I have access to, you're welcome to reach out. Thanks for watching. Enjoy the rest of your day and see you next Tuesday.